welcome to the concluding panel of this conference. So over the past 2 days, we have discussed a broad range of risks to financial stability, focusing on both banks and non-banks, and asked how monetary policymakers and regulators should act to contain them. And together with my two distinguished panelists, we will now put all of those insights together and ask, what could the next financial crisis look like? Financial crises are a recurrent phenomenon, as President Lagarde reminded us yesterday, and they tend to be deeply disruptive for our economies. The last global financial crisis started almost exactly 17 years ago, on the 15th of September 2008, and many of us remember vividly not only the sequence of events, but also their severe consequences, including the subsequent balance sheet recession, the European sovereign debt crisis, and the low inflation, low growth period. Some economists, including our keynote speaker Raghu Rajan, and the authors of the first paper this morning, have argued that monetary policy responses to this latter episode may themselves have given rise to new financial stability risks. However, in spite of repeated episodes of severe financial stress in recent years, we have been spared from another full-blown financial crisis. But there were at least two instances when we may have been close to another financial crisis, serving as an important reminder of the fragilities inherent in our financial system. The first instance was after the start of the COVID-19 pandemic in 2020, which exposed the fragility of financial markets as investors flew to quality in a dash for cash. At the same time, we witnessed how non-bank financial intermediaries amplified the market turmoil through fire sales. Central banks and governments intervened massively and thereby successfully prevented another global financial crisis, as Marie's paper illustrated. But this also meant that risks were transferred from the private to the public sector, for example, through broad-scale guarantees to corporates, which shielded the banking sector from credit risks. At the same time, this prevented a credit crunch, which could have further deepened the macroeconomic downturn. The second episode of financial stress that I would like to mention occurred at the time of the historically steep hiking cycle in many parts of the world in order to fight the unprecedented surge in inflation. Especially after the prolonged period of low interest rates, rapidly rising rates led to the materialization of interest rate risk, a topic that we also discussed yesterday afternoon. Bank runs at Silicon Valley banks and other institutions in the United States reminded us of the traditional fragilities in the banking system. The fact that the euro area was largely shielded from similar events can also be seen as a compliment to our regulators and supervisors who managed to avoid a crisis in these very challenging times. Despite their differences, these episodes share common features that resonate with historical experience. Financial crises are often preceded by accommodative policies, excessive credit growth, liquidity and maturity mismatches, high leverage, deregulation, and financial innovation. Similarly, liquidity mismatches, high leverage, heightened pro-cyclicality, and a lack of macroprudential regulation have featured prominently in periods of stress in the fast-growing NBFI sector. In addition, its growing interconnectedness with the traditional banking sector raises the risks of spillovers and an amplification of shocks. And these risks are compounded by the ongoing wave of financial innovation. The rapid rise of crypto assets and so-called stablecoins might reintroduce familiar fragilities in new forms through volatility, opacity, liquidity mismatches, leverage, concentration, and contagion. So far, we have not seen how these new asset classes behave under severe market stress and how they could be linked to the traditional financial sector, leaving open questions about their potential to exacerbate financial instability. Today, we're facing an environment of heightened uncertainty. From escalating geopolitical tensions to lingering fiscal concerns and increasing doubts about international collaboration, the global financial landscape has become not only more complex, but also potentially more fragile. While the patterns have tended to repeat themselves, the precise way in which financial instability may play out is unknown. But we are lucky to have with us two distinguished speakers bringing a wealth of experience and complementary perspective to help us bring some light into this. And I would like to start with Klaas as a first speaker, who until very recently was the president of the Nederlandsche Bank, the chairman of the Financial Stability Board, and most importantly, a dear colleague in the Governing Council. He's also professor at the University of Amsterdam and honorary professor at the University of Groningen. Klaas is known as a sharp thinker with a keen interest in financial stability, which he defended not only in the euro area, but also in the international arena. So Klaas, thank you so much for being with us today. So maybe you can tell us, what do you see as the likely cause of the next financial crisis?
Well, thank you very much for this introduction, Isabel. And it's a big pleasure to be back in Frankfurt and to find out that access to the building is still there. And so I made it, I'm here. I'm here to talk about actually quite an interesting subject. Where is the next financial crisis going to come from? Because we all know, since Raghu, I don't know whether Raghu is still with us, I saw him earlier this morning, but anyway, since his 2005 Jackson Hole speech, we know that risks always go somewhere and that you have to ask the questions, where do they go actually? Now, in trying to answer this question, where might the next financial crisis be coming from? You already hear that I'm reformulating in a slightly more cautious way. I think it behooves us to first look at what are actually what have been the major trends that have shaped financial intermediation over the last few decades, and what I will argue have also changed the nature of systemic risk in the financial system. And I would start by saying, first of all, it is the emergence of public debt. So more and more credit is now going to public debt. There has been some form of crowding out of private debt to public debt. We saw this morning, by the way, that within private debt, there has been a crowding out of corporate debt by mortgage debt, but that could be subject of another other discussion. But I think it's important to take away. So global bond markets and developments in global bond markets have become much more important for financial stability because of this trend. Second trend is the trend, you already mentioned it, Isabel, away from banks to non-bank financial intermediation. Non-bank players are hugely important in bond markets, in other bond markets. Hedge funds that are quite highly leveraged, but also traditional insurance and pension funds that tend to have quite correlated investment strategies, which is an issue in and of itself. And that also means that if you think about systemic risk, that if you move from banks to non-banks, systemic risk also is more now an add-on to liquidity risk rather than to credit risk. So traditionally, we've always been strongly focused on banks and credit risk, but in non-banks, it's primarily about liquidity mismatches. The examples you mentioned were clear examples where there were spikes in liquidity demand, and non-bank financial entities were actually hastily trying to reduce their exposure to these mismatches. And that led to sort of fire sales, correlated fire sales that could only be countered by central bank intervention. Also, NBFI is of course more cross-border in nature. Markets are even more interconnected than banks were. So that all leads to the conclusion that probably most of the financial stability risk in the spectrum are coming from outside the banks. I don't want to completely discount banking risks, and we will probably also come back to that later. But when I think about the main sources of risk that I see at the moment, I think primarily about NBFI, and let me elaborate on two concrete examples. One is private credit and the other one is stablecoins. Private credit has grown very, very rapidly over the last few years. And that is a potential risk to financial stability. In the meantime, it's a 1.2 trillion US dollar market. 87% of it is originated in the US, only 6% in Europe. But also in the provision of private credit in Europe, some 30% of that is originated in the US, actually, by US suppliers. Now, private credit, by its very name and sort of manifestation, is of course more opaque. It's more illiquid, less liquid than sort of credit through the banks. The sector is also highly concentrated. So you have 10 funds, mostly US, of course, that account now for a third in total global lending. And for instance, if we look at the Herfindahl X for loan origination within private credit, that is 20 times the Herfindahl index for loan origination within the banking sector. Just to illustrate the amount of concentration that is there within private credit. Thirdly, private credit is also concentrated on a very few sectors in the economy. And for instance, business development companies, is big, financed by private credit, leverage nearing 90% in these loans. And so that raises the risk of pro-cyclical deleveraging. For the last 15 years, we've been recapitalizing the banks in order to turn the banks from shock amplifiers, which they were in 2008, 2009, into shock absorbers, which they were in the crisis of the last 5 years, the Dash for Cash, Archegos, the UK LDI, and what have you. But unfortunately, such is not the case for private credit, and private credit has never witnessed an economic downturn. For banks, when credit deteriorates, they have workout procedures. They have specific departments that sort of deal with fallen angels, etc. If you start talking to providers of private credit, they have nothing of that kind. So what I really worry about is significant procyclical deleveraging, as there is not the same amount of resilience in private credit than there is in the banks. And then we know, of course, that when credit starts to deteriorate, then you have to move credit off your balance sheet. And that is the procyclical deleveraging that I would possibly worry about. Second point is stablecoins. That's also a recent development. Now, before going into the risks, let me also say there's a tendency in our circles to be a little bit sort of bashing stablecoins, etc. And many of us are, of course, coming from advanced economies where you have a sort of sophisticated banking system, you have sort of fast payments and well accessible, cheap, you can go anywhere, etc. But let's not forget there is another part in the world where cross-border payments within the banks are laborious, are expensive, are non-accessible, etc. So there is a business case for stablecoins in these countries, in those parts of the world. So it's not just about risks and negativity as far as I'm concerned. But nonetheless, I was asked to talk about risks and possible next financial crisis. Of course, stablecoins are a little bit like money market funds in terms of structure. So the stability of stablecoins depends very much on the stability of the underlying assets. And the underlying assets, well, much of it is sovereign debt. I mean, the biggest two stablecoins are also the biggest parties now in the auctions of fresh sovereign debt. So Tether is the biggest party when sort of the US issues treasury debt. Then Tether is the number one absorber of that public debt. And we know that there have been liquidity runs and liquidity squeezes in public debt, in sovereign debt markets. And then, of course, you don't have to have too much imagination to think about the possibility of a run on a stablecoin, because stablecoins are not transparent, are opaque. You don't know whether the reserve asset requirement is really met at each point in time. Stablecoins are also used to settle, let's say, transactions in crypto assets, in risky crypto assets. Well, they also bring about a lot of volatility. So there are at least two sources of possible shocks in this stablecoin structure that could lead to unease about stablecoins and could lead to a run where of course there is not such a thing as deposit insurance to sort of instill confidence at these times. So these would be I could probably talk about a few more, but these would be my sort of two issues that I worry about most.
Thank you very much, Klaas. Just one very short follow-up question on this. I mean, so we know that stablecoins so far play a very limited role in Europe. So what about private credit? What is how relevant is it quantitatively in Europe? Do you have the numbers?
Yeah, well, 87%, as I said, was originated in the US and only 6% in Europe. So it's still a bit smaller in Europe, but it is concentrated in a couple of sectors. For instance, the healthcare sector, where you have a lot of private credit, and these business development companies. So in Europe, it's not so much yet the size, it's more the concentration on only a few sectors.
Okay. Thank you very much. So now I hand over to my second panelist, Pierre-Olivier Gourinchas, who is the chief economist of the International Monetary Fund and a professor of economics at the University of California at Berkeley. Pierre-Olivier is one of the most influential international macroeconomists who has consistently published in the very vast academic journals. And we are very much looking forward to hearing your perspective on what the next financial crisis could look like.
Well, thank you very much, Isabel, and thank you for inviting me. And I come with a background that is maybe more on the macro side than on the financial side. So I will offer remarks that complement what Klaas has mentioned by highlighting some of the risks also on the real side of the global economy. But I would start to say that predicting the next crisis is kind of difficult. My former colleague Barry Eichengreen used to say, I can tell you where the next crisis is going to be or when it's going to be, but I cannot tell you both. And I think that's probably right. So I will not attempt to do that today. I will highlight four main risks, some of which also have been mentioned by Klaas. So the first one I would mention is fiscal fragilities. So I'm concerned, we at the fund are concerned that fiscal fragilities have increased since the COVID crisis and that they could threaten macroeconomic stability, but also financial stability and even monetary stability, and so amplifying financial risk as well. So let me explain. So first, we've seen the increase in public debt. We've also seen the increased pressure on long-term bond yields. We've seen the yield curve steepening. If you look at US Treasuries, if you look at European government bonds, if you look at UK gilts, if you look at the Japanese government bonds. So the yield curve has been steepening around the world and for most advanced economies. This is something that's probably been reinforced by quantitative tightening that basically releases some of the bonds into the market that have to be absorbed gradually, but still have to be absorbed. And so you can imagine that if there was a sudden loss of confidence in sovereign bonds, especially in countries that have a little bit more precarious fiscal position, then that could be something that leads to financial instability, leads to price adjustments, leads to disruptions in financial markets, and then financial volatility. Now, one worry we have is that there is a temptation in situations where the fiscal outlook is a little bit more precarious. There could be a temptation in some parts of the world to exert pressure on central banks to lower interest rates. That's something that we see in a number of countries, by the way, in order to maybe contain debt servicing costs. And so I want to be very clear that from our point of view, this would be a terrible mistake, and I think that this is probably a view that is shared by many of you. Central banks are not free to set interest rates as they please. They must do so in order to achieve their mandate, which includes price stability and in some cases full employment. And they therefore have to stay close to whatever is the neutral rate, however difficult it might be to estimate that. So any attempt to deviate from this, especially on the lower side, would create more price pressures that would be priced in the bond market. Therefore, it would be self-defeating, would not necessarily increase or lower the financing costs for government. It would increase risk premia, would increase volatility, would increase inflation pressures, and would also destroy one of the key assets that central banks have, which is their reputational commitment to keep and achieve price stability. So it's very clear that for us, this is not the direction to go. But when you have a situation of stretched fiscal position, it has to be addressed on the fiscal side. The second risk I want to mention is also a financial risk, maybe a bit more bottled up initially, but I think it's nevertheless relevant and certainly relevant for the global economy. It's the unresolved real estate crisis in China. And here, I think that this is something that is still with us. It's been a number of years. Now, we know from historical experience, other countries that have been through a real estate crisis, whether we think about Japan or you think of other countries in the world, it takes time. It takes time in part because this is a difficult problem to solve, but also because there is often a tendency not to address the root cause, not to address it in a way that allows the economy to move forward, because it means realizing losses, recapitalizing financial institutions that need to be recapitalized, and then moving on. And that distributional aspect of who is going to bear the costs of resorbing the crisis is something that often takes time, and from that perspective, China is not in a different position than other countries. This is relevant also in the context of public finances in China. The local government financing vehicles, their debt represent about 47% of GDP as of 2023. The updated numbers are probably not very different, and our estimate is that about 40% needs restructuring. So this is a very sizable problem for China. The resolution has been very piecemeal, very insufficient from that perspective. And so the result is that the Chinese economy is teetering on the verge of a debt deflation type recession, where global activity is and global demand, the domestic demand is weak, price pressures are actually very, very weak. You have inflation being very low, and in some sectors even deflation, and then therefore the real cost of debt are increasing, et cetera, et cetera. So that's something that certainly is an issue for the Chinese economy. But I would say that it also highlights, if you add to that the fact that the response of the Chinese authorities up until now has been to put all their chips on the manufacturing and the exporting sector to try to grow out of the weak domestic demand through the export sector, we see how in the current environment this is a path that is going to be very, very difficult to achieve. And we see evidence of also overcapacity and deflation in the manufacturing sector and mounting non-performing loans in that sector as well. If you look at, for instance, the solar panel sector, many of the Chinese firms in that sector have achieved tremendous productivity gains, but are also generating substantial losses. Third, I won't dwell too much on it because Klaas mentioned it. We are concerned about what might happen with stablecoins. I want to reiterate what Klaas said, which is there is a business case in many parts of the world for having access to a means of transferring funds cheaply without exorbitant fees. And that offers some amount of protection against domestic macroeconomic policies that might actually be quite detrimental. So I think there is an argument to be made there. But of course, there are underlying risks. One of the risks is, from our perspective, that there could be a rapid adoption, especially cross-border, that if we have an event where you have a run on stablecoins, there are two issues with that. One is, if they are holding large amounts of US government debt, for instance, most of the stablecoins at this point are dollar stablecoins, that could impact the government bond market. They tend to be holding at the short end of the maturity curve. They are not holding long-term because that would not be the kind of liquid assets that you want to have. So there is concentration on the short end of the maturity curve. If they have to liquidate, that will create a hole pretty quickly. In some jurisdictions, including Europe, stablecoins are also holding bank deposits. Even in the US, if you think about Silicon Valley Bank, one of the stablecoin issuers broke the buck was that because they were a large depositor in Silicon Valley Bank. You could imagine that that means there is concentration risk potentially on the banking side if you have large amounts of deposits that are concentrated in a few stablecoin issuers. So these are the kind of risks that we have to think about going forward. Fourth risk I want to mention, and that's the final one, is something that we see in the US right now is sizable signs that we have a very strong AI-related investment boom. The size of AI-related investment in the US right now is very significant. Non-AI-related investment is basically flat. Most of investment in the US has an AI component, whether it's software or whether it's data centers and other things. Some of this is predicated on future productivity growth and profitability. What it's doing is that, of course, it's driving up the economy. You can think of this as kind of a demand shock in the near term, maybe similar in some ways to what we had in the dot-com boom period, 96 to 2000, and some of the dynamics may be similar there as well. But then there is a risk of we have what happened in the dot-com. It ended with the dot-com crash. And so one of the risks that we see especially in the US economy is that some of the valuations in the AI sector, some of the very optimistic projections for that sector will not be realized. Now, this matters in different ways than in the dot-com period. One of the things that you have is extreme concentration of this investment in large tech companies, unlike the AI period, the dot-com period, where it was basically pet.com and a bunch of other startups that are receiving a lot of funding. Here you have things that are very, very concentrated, and that matters for how the index might respond to this and might create wealth effects and confidence effects. So one of the risks that I think we should be thinking about is the potential market correction when we're thinking about the AI-related sector. I'll stop here.
Thank you very much, Pierre-Olivier. Actually, many of the risks that you mentioned were focused on other countries, not Europe. So what kind of spillovers do you see from those risks to Europe?
I think not all of them are on other countries. I think I've mentioned fiscal risks first. So I think I mean, this is interesting, and I mean, I think that, of course, the stablecoin is also something that could create some risks for Europe and not just other countries. I'm not concerned about currency substitution, of course, for a region like Europe, but you might have adoption of stablecoins that also creates. I mean, there are a number of risks associated with adoption of stablecoins. One of them is there are potentially fiscal risks. I mean, to the extent that it might facilitate tax, quote-unquote, optimization. That's something that could be relevant for public finances.
Multi-issuance.
Multi-issuance.
In different jurisdictions.
Multi-issuance is another thing that the ECB in particular and the SRB have been looking at. The fact that, you know, basically, how can you issue a stablecoin at par into different jurisdictions when you have different regulatory environments? There is obvious arbitrage there, so that creates some problems. The AI boom has an interesting implication, which is that if you think that it's driving up interest rates, it's sucking up a lot of resources into investments, driving up interest rates. Europe is going to face the higher interest rates because this is a global market. It's not clear it's getting as much of the higher growth. And so the R going to be going up, the G may not be going up that much. That is adding to the fiscal pressures in the region.
Thank you very much. So back to you, Klaas. So you emphasized a lot the risks in the non-bank financial sector. So of course, we've also recently seen some risks materializing in the banking sector. And what we are now seeing is that there is a lot of push also in Europe for what is called simplification, which may end up to be more deregulation. So are you worried about that? So do you also see any spillovers from the risk you identified, like back to the traditional banking sector?
Yes, I do. I think if you think about the banks, it's always good to keep in mind that banks are among the more or even most highly leveraged entities in the financial system. So it means that whenever you worry about systemic risk, you worry about contagions, the banks are never far away. And I spoke about the non-banks, but the separation between banks and non-banks is of course not a black and white separation, because out of the 1.2 trillion, for instance, well, the numbers are not completely comparable, but roughly 500 billion of non-bank, of private credit funding is funded by the banks. So roughly 500 billion. It's not entirely comparable to the 1.2 trillion that I mentioned earlier, but it is safe to say that, let's say, a quarter to a third of the funding of private credit vehicles is provided by the bank. So here you have a possible contagion channel. Yeah, and this push that you talked about for simplification, I mean, let me also here try to start on the positive end. Of course, banking regulation for 15 years has had the wind in its sails, right? I mean, there was growth, there was huge growth of supervision, of regulation and everything. And I tend to believe that if you have whatever business you run, but if you have 15 years of growth in a certain business, it's good every now and then to take a step back and sort of ask yourself, has all that growth really been invested in the right places and the right resources? So I could dwell on that and I have a couple of sort of concrete subjects where I think simplification should be on the agenda and is probably on the agenda. But I would worry if simplification were really to morph into deregulation. Again, what I said, I think I look back on the financial reform agenda that was focused on the banks as a very successful exercise in changing the banks from shock amplifiers into shock absorbers, what we've seen. And that's what we want the banks to be, right? I mean, there is also ample empirical evidence that better capitalized banks provide for more stable lending. We just don't want to see as much lending, but we also want to see stable lending that is not withdrawn at sort of the first instance of turbulence. So if simplification were to morph into deregulation, yeah, that would worry me. I think there is a gap in, let's say, the level of resilience in banks versus NBFI. So there is an unlevel playing field. That's absolutely true. But you can solve it in two ways, right? And at least my efforts in the Financial Stability Board over the last 4 years have been to try to bring the resilience in the non-bank space more up to par with the resilience in the banking sector. Now, in other parts of the world, they now seem to talk about lowering the level of resilience in the bank so that the activity migrates back into the bank. But I would prefer to bring about that migration by actually bringing NBFI resilience up to par with that in the banking sector.
I think we can easily agree on that. So, Pierre-Olivier, you talked a lot about the fiscal pressures that we're seeing in various countries. So, do you see the danger that this could feed into dysfunction in government bond markets, and what would this imply for global financial stability?
Well, obviously at some level, if I think the fiscal trajectory is not stabilized. And here I want to emphasize that, it's not that it's increasing and getting out of control in all countries. I mean, when we look at our global debt database, for instance, it's very clear that you have two big outliers. One is the US and the other is China. For most other countries, debt to GDP, public debt to GDP, has been kind of, went up a lot during COVID, came down with the surprise inflation, and has been sort of drifting up, but slowly, and is projected to continue drifting up. And the question is, how much should we worry about this continued drifting up? And certainly we believe that the many countries should rebuild fiscal space. And one of the reasons why it's important is not so much that if you couldn't sustain deficits or debt levels at the level where they are, you probably could, but probably is not good enough. We are in a world in which we have pretty sizable shocks, if we think about the last 10, 15 years. And one of the things that's been really important, and the empirical record on this is very, very clear, that countries' ability to deploy fiscal resources quickly in a large crisis like COVID, for instance, is critical to mitigate the long-term effect, the scarring effects of the crisis on income per capita. So advanced economies came out much better, and especially those with more fiscal space, much better out of the COVID crisis than emerging market or low-income countries, which are not able to deploy the same kind of fiscal support for their population. And you see that very, very, very clearly in the income per capita. There's an enormous amount of scarring that is still there, out there in the world. So you need, faced with a shock that is sizable, you need to be able to deploy maybe 10 percentage point of GDP. The question is, and I think this is a point that Raghu was making yesterday, can we afford it if a shock that size happens? And I think that's a valid question. Therefore, the call to rebuild some of that fiscal space. So the question is not so much that necessarily the bond markets won't absorb. I think they will absorb at a certain price. We're seeing right now that it's fairly moderate in terms of the pricing, but accidents can happen, and I worry very much about these accidents.
Yeah, so before we open for the Q&A, maybe can you tell us what do you think are the main solutions to the problems that you identified? So what should the regulators, the supervisors, maybe also central banks, or even governments focus on?
Okay, well, first of all, over the last 4 years that I've been at the helm of the Financial Stability Board, we tried to strengthen NBFI resilience. And roughly, that was subdivided into 2 strands. First of all, you have the entities within the NBFI space, money market funds, open-ended investment funds. And we tried to strengthen liquidity management within these entities, a better management of these liquidity mismatches and anticipation of these liquidity spikes. But then again, the NBFI space is not as homogeneous as the banking sector. Some would argue that not even the banking sector is homogeneous, but NBFI is even more heterogeneous, I would say. And so you also have a couple of cross-cutting issues that are quite important to tackle, and 2 of them in the NBFI space. The first is preparedness for margin calls. The Bank of England has done a sort of system-wide liquidity stress test recently, and the liquidity the demand spikes in liquidity that they simulated, more than 90% came from margin calls. So liquidity needed to meet margin calls. So that is really an area where I think the financial infrastructure needs to be strengthened quite a bit. The other cross-cutting areas is leverage. Also in NBFI, leverage is there in the 5 episodes that you mentioned. All of them also had in common that pockets of hidden leverage all of a sudden popped up in areas where we had not expected it. That's very difficult to say, if I'm honest. I mean, we issued a couple of recommendations, but most of the recommendations that sort of on which you find global agreement are high level in nature, and we need much more granular follow-up regulations to really address the risks there. The same, by the way, is true for stable coins. Nowadays, you can take a server under your arm and issue these stable coins or crypto assets from any place in the world. So you really can only have an effective global supervisory regime if you also have a commitment to implement. And a commitment to implement, and you also need to have disciplining mechanisms for those that are unwilling to implement, the so-called offshore financial center issue. I don't think all these issues have been solved yet. We need more international cooperation to solve these issues. Well, and that was always a challenge, but definitely today it is a challenge.
Thank you, Klaas. Pierre-Olivier?
I will be brief. I mean, starting with so very clearly on the fiscal issues. I mean, there is a need to consolidate, which doesn't mean, by the way, doesn't mean that somehow there has to be an abrupt stepping on the brakes. I mean, I think what we recommend is that there should be gradual, credible, timely consolidation, and that will signal to the market that you're going to go there, and that will be reflected in funding costs, and that will already provide some help. But we're not seeing that in many jurisdictions. Second is maintaining good monetary frameworks in addition to the fiscal frameworks. And here I want to flag one sort of piece of good news. We are wondering about the next crisis, but one of the places where there's been tremendous improvement in resilience is emerging markets. Emerging markets have been going through the same crisis, but we haven't had an emerging market crisis despite everything that happened since 2010. So I think that's something to take on board and realize that a lot of these countries have actually done the hard work. They've improved their monetary frameworks. They've made their fiscal policy much less procyclical. They've introduced fiscal rules in some countries. They've introduced macroprudential rules. So they've buttressed their financial sector. So they've made themselves much more resilient and therefore put themselves in a position where they can let exchange rates fluctuate a lot more and absorb external shocks in the way that we think that they should be doing, and that there's been a lot of progress in that direction. So I think that's a lesson that emerging markets have been doing it. Maybe some advanced economies need to be looking at what's happening there. Third, on China, and here the answer is very, very clear. You sort of have a transfer of resources. You need to reorient demand towards the domestic sector. The only way to do that is to restore confidence and clean the property sector. Our estimate is about 5 percentage point of GDP to clean up the property sector. So that's a substantial amount of fiscal resources, of course, but there is a substantial amount of resources that are spent, in our view, in a way that contributes to misallocation of activity in China through non-market practices, subsidized lending, subsidies in different sectors. And the reason I'm saying it's contributing to misallocation is if you look at the difference between some of the flagship sectors like EVs, et cetera, we are showing tremendous productivity gains, but you look at the aggregate picture, aggregate TFP in China is really, really, really very low. So that tells you that somehow a lot of things are not going in the right place. On stablecoin, I mean, the fund and the FSB work together. They're very aligned in terms of policy recommendations. This is very high level, and as Klaas mentioned, there is a lot of work that needs to be done more at the ground and the level of the regulators and coordination.
So thank you very much, and we can open the floor for questions. Okay, so maybe we just move from here to there. So please, Anja.
This is a question for Pierre-Olivier, and I can't resist, given all of us know Pierre-Olivier is one of the leading scholars on international finance and international macro. Two other leading scholars, Arvind Krishnamurthy and Hanno Lustig, wrote a paper in April, did a panel in May, where they suggested that perhaps the US was starting to lose its reserve currency status, given some of the policy decisions. It didn't make your top 4 list, so I was just wondering, is that something you're thinking about? Is that something you're worrying about? How would we detect whether that is happening? Perhaps that we should start ringing the warning bells.
Is it okay if we collect 3 questions? Yes. Because we have so many. So I think, Philip, you were the next.
Okay, Philip Hartmann, ECB. So payment and settlement infrastructures have been a bedrock of financial stability since quite a while. And the central banks have learned that lesson quite a while ago, and we developed very safe systems. But now we are entering, and the stablecoin issue is just one example, a period of disruption in the payment side that I personally believe will be with us for the next, say, 5 to 10 years, and can be very disruptive, even beyond payment systems. And what I'm heading for is your advice on the technological orientations of the central banks to keep this achievement that we had since quite a while, that in the recent crisis or last 25 years, nothing or really that decisive came from that side. When we go in this transformation, and I'm particularly interested in the side of in kind of adopting ourselves some of these technologies that are so successful in the stablecoin, which is the distributed ledger. Whether you have advice for us how we should think about this compared to our shared ledgers on which we usually build our main payment and settlement systems. So how we should go forward, like more go in the direction of the market, which has developed some dynamism on the distributed ledger technology even recently, including the stablecoins, or like how we can preserve this great achievement, and which technology we should go, in which technology we should base our decisions. Thanks.
Philip.
Hi, Philip Schnabel from NYU Stern. I also wanted to ask about the stable coins. I mean, I agree with everything you say. You've emphasized this potential for tax evasion, there are worries about runs. But if you take that off the table for a minute, supposed to invest in reserves and actually regulate it, another aspect of this is that there may be a competitor for bank deposits. And, we know that deposit rates don't move one for one with the short rate. I mean, in the US alone, if you think about, we went from the zero lower bound to, max of 5%. At the same time, deposit rates on average went up 2%. That actually, in terms of spread, meant that per year, 20 trillion of bank deposits, banks earned an additional spread of 300 billion per year. That's more than stablecoins are actually outstanding. They're on the order of 270 billion. So there's also a big opportunity in terms of, a competitor which, we usually are missing for the banking sector. So, potentially from the household perspective, that may actually be a plus. So there's an opportunity. Now, if a regulator looks at this, we just had a paper on regulators, they may usually say, well, these bank deposits not paying a lot is actually a good thing. It helps financial stability, it contributes to the franchise value. So I think there's sort of another dimension in terms of stable coins, which both has risks, but also great opportunities. And I wonder what your thoughts are on this.
Thank you very much. So who wants to start? Okay.
I'll say something to Amir's question and then maybe to Philip on the competition with the banks. So on the dollar, you're right, it doesn't make my top four. There's always a risk somewhere, but I think it's a very distant risk. We actually looked at the evolution of the international monetary system in one of the reports we put out in July, our external sector report. We had basically doing some stock taking on this. Really, the picture that jumps at you is the dollar dominance is extremely strong across all dimensions. And we know that there are complementarities between these different dimensions, whether you're looking at invoicing, you're looking at debt issuance, looking at reserve management, you're looking at which currency countries want to peg their own or stabilize their own relative to. All of these things kind of reinforce each other, and they're still there. So we don't think that picture has changed dramatically. We've seen something a little bit surprising in April, which has been, despite the fact that you had volatility in the bond market, you had the yields going up in the US, you had equity markets coming down. Typically, this is kind of a risk-off event. In previous risk-off events, you see the dollar appreciates, there's a flight to safety, and here, well, surprise, surprise, the dollar depreciated. And so there's been a lot of looking at what's been going on with that. Our understanding, and we're doing some work also on this for the annual meetings and our Global Financial Stability Report, is a lot of this is not so much investors moving away from dollar assets. Actually, we still see a lot of inflows, whether you're looking at equities, you're looking even in sovereign bonds, you see very sizable flows. It's more of a change in the demand for hedging. So all of a sudden, what you had is investors keeping their dollar position, foreign investors keeping the dollar positions, but increasing the demand for dollar hedging against a potential decline, depreciation of the dollar, which of course brings it forward. So we've seen relatively stable portfolios so far, and we are not particularly concerned about where we are right now in terms of the dollar status. Now, there are a number of things that could change the pictures going forward. I mean, clearly, geoeconomic fragmentation plays a role there. The way other countries, other investors are looking at the dollar really depends on, the set of rules and the set of norms that are implemented around the world. And if these are very substantially upheld or changed, then the picture could change. You could argue that the fiscal trajectory might also matter. And foreign investors might look at what's happening in terms of public debt in the US, and the safety of US treasuries might be something that they want to think about. Although if you look at the recent budget bill in the US, if you add to that the tariff revenues that have been coming in, actually the fiscal picture is not deteriorating at all in the US, or very, very little in the coming years. So it's kind of plateauing. It's not improving, but it's not deteriorating. And then there's the question of cryptos and whether that might actually be a plus in terms of generating demand for US treasuries to the extent that you have dollar-based assets. So it's a little bit of a mixed picture, I think, but there is no sense from where we're standing and where we're looking at the numbers that things are changing dramatically. One of the things I would add to that is one of the really striking feature of the world economy right now is the asymmetry you have between trade and finance. I mean, the US is really dominant in terms of international financial flows. But in trade, it's a much more multipolar world already, where you have, China and other countries are very important. And that asymmetry between the role of the dollar in trade, in finance, and the role of the US, the size of the US in terms of international trade, is something that is allowed under sort of a dominant currency. So a sign that we might be closer to something that the system might be changing would be if you have less of this asymmetry, because that means that countries somehow are less willing to specialize along lines of comparative advantage between finance and trade. So that's kind of one place where I would look at. Very quickly on Philip's question on stablecoins, I think that's the big battle that we're going to see. That I want to separate the sort of the domestic versus the cross-border aspects. The domestic aspect, there is enormous, in the US, this is the battle. Who are going to be the banks of the future? Is it going to be the stable coins, basically? Or is it going to be the banks sort of absorbing the technology and offering this through tokenized deposits or things like that? Now, the stable coins right now are not there because they're not offering direct remuneration and they're supposed to be holding high-quality liquid assets. So you can think of them as narrow banks. Yes, they are disintermediating the banks. That's possible. They are like a better money market fund because you can make payments with it. You can transfer money, unlike your Fidelity money market account where you have it's cumbersome to move money in and out. So it's much more convenient than a money market fund, and it's going to come in the banks. And what you can anticipate is there is going to be a push for them to compete even more head-to-head with the banks by starting to offering remuneration and becoming more fractional banking with the risks that come with that. So I think that's where the regulators have to be sort of holding back and say, no, you guys want to be holding something at par, then you have to be really safe. And that. So the banks are seeing the danger, and they are already moving in that space. And I think what shape it's going to take, we don't quite know. But that risk is very much there. So let me stop here.
Yeah, I mean, I think you covered the ground quite well. I mean, on the reserve currency, I can't sort of resist also saying that many people in this room would perhaps prefer to see a gradually growing role for the euro, for instance, as international reserve currency. But I really think that the external strength of your currency is a reflection of your internal strength. And it means that in Europe we first have to sort of do our own homework in terms of strengthening the internal cohesion of the internal market, of our capital markets, of our banking system, etc., before we can sort of start dreaming from a bit of a shift here. And in other parts of the world, there is issue with convertibility of currencies, etc. So the simple reality for the US dollar is also there is no alternative. And I think that will be with us still for quite some time. Philip, you asked quite a difficult technical question on distributed and shared ledgers, etc. And I would not count myself among the experts in that field. But what I do know is that I think that central banks should be active in this space. So if the whole world is digitalizing, I mean, our payment system has always been a mixture between public money and privately created money. Cash is probably, well, I'm not saying on the way out, but it is clearly, its use is severely diminished. I mean, my kids, if you try to tell them what cash is, they sort of look like you're coming from a different planet. So if we want to preserve also a public imprint, let's say, in money, then I think central bank digital currency is the logical answer. It's also a logical answer to keep abreast of these technological developments. And there also a little bit of a geopolitical argument comes into play, that for all the payments instruments that we're now using in Europe, we are very, very much dependent on technology that is coming from outside Europe. Even payments products that seem to be very European or national, if you go at the back office, it's all being driven by 2 or 3 suppliers, let's say, outside the EU, outside the euro area. And well, one wonders with strategic autonomy, etc., whether that is a healthy system to stay in. So I do believe that central banks should be active here. And if we would not be active, I think going forward, we would blame ourselves at some point. How did we allow it to happen that sort of our money system evolved into a complete private money system only? And yeah, I think public money is the bedrock. It provides stability. The fact that money can always be changed into a public instrument, I think, provides stability. And we should cherish that also in the digital world.
Thank you very much. So I'm going to collect 3 questions again from Marcos, José Luis, Victoria. Could you please be relatively short, and also the answers should be preferably a bit shorter than the previous one so that we can have another round if possible.
So Marcus Brunnermeier, Princeton. I have two questions. One is, Klaas, you didn't mention much private equity. I noticed you spoke only about private credit. Are you worried about private equity? And do you think the illiquidity in private equity is a plus or a minus for causing something? And do you think it will be contained in the United States, or there might also some spillovers occurring towards Europe as well? Then my second question is more generic. Do you see any new mechanisms for crisis? So we heard a lot of traditional ways crisis can emerge and in different traditional areas, but do you see new elements coming, that the speed of a crisis is speeding up much more, that we have AI agents trading or the artificial intelligence introducing new elements in financial markets, which also lead, at least not immediately, but in a few years, to very different forms of crisis as well, or you don't see that?
Yeah, José Luis Pedro from Rome. So you said yesterday and today that a big risk is the public debt and the fiscal positions. And I got from your comments that this is more once the crisis arrives, you don't have these buffers, and that will be bad for systemic risk and for the economy. I wanted to ask you about the ex-ante build-up of financial imbalances. So if you know that you don't have that money, both through fiscal policy once the crisis arrives, because public debt is very high, and monetary policy at the end depends on fiscal policy, could it be that supervision becomes softer? Because then you know that if you want to be very tough with the banks, maybe at the end, close to the crisis, there will be problems in the banking sector, but there is not this backstop. So in a sense, that fiscal policy will not be exposed, will be ex-ante, making the system more prone to financial imbalances. On the other hand, if you know that you cannot save the system, you cannot do bailouts, the central bank cannot help so much, maybe the supervisors become tougher. So what is your opinion on that?
Victoria Washington, Harvard. My first comment, two comments. The first one relates to Marcus's a little bit. So private debt today backs primarily private equity activities. The bulk of it is private equity activities. So as of last year, the equity check for a buyout was 48% of the entire capitalization. Let's make it a 50. So it's 50 debt, 50 equity. And so if you're going to go off 1.2 trillion in debt, that means that you have to burn first and foremost 1.2 trillion in equity, which is sitting throughout pension funds and insurance companies, etc. So the question is Marcus's question. What do you think is wrong with private equity first and foremost? And perhaps there is an additional channel that we should be thinking about, which is portfolios of pension and insurance. The second comment relates to concentration. So this idea of private debt being concentrated in particular in a few industries, which is a fact, well-documented fact. That again goes back to the fact that private debt caters to private equity, it shadows private equity. Private equity has always been a very industry-concentrated activity. Industries shift over time, but in any given point in time, it tends to go to specific industries. Now, that actually gives us a window of how to think about concentration of that portfolio, because private equity was funded by securitization, collateralized loan obligations, so broader leveraged loan market before in the financial crisis in 2008. So those portfolios, which by the way were levered 9-to-1, were already concentrated portfolios of debt. And they did not default on their AAA securities, which were cutting through 60% of their capital structure. So the question for you is, do you think the industries are different, or what is different, given our experience with concentrated portfolios of debt in 2008?
Well, pretty tough questions. I mean, to begin with the private equity, private debt, of course, every transaction is different, and so to generalize across the entire private equity spectrum, a lot is concentrated in IT and in health. These are, I think, the two sectors where you see most of these transactions. In principle, if you have a 50-50 situation, that of course there is a lot more equity in the transaction than is there in a, let's say, a traditional banking system, which is much higher leverage. And when I think about systemic risk, obviously I am worried about private equity. I'm particularly worried about sort of leveraged transactions, and so in and of itself, therefore, private equity, I mean, it has a negative, let's say, air around it in many of the public discussions. But as long as it is truly equity and people are willing to absorb losses with it, which is the main function of equity, that is not the part that I would very much worry about, and not even the illiquidity. I mean, these are often family offices. They're very abundant, or persons with abundant wealth that put their own wealth on the line. So that is not. I worry more about the private credit part. Because I do think that not all of these exposures are well understood, and particularly the procyclicality element, as I mentioned it, because we have not yet weathered an economic downturn. We've had a massive growth in this private financing business, but the thing is, when we will get an economic downturn, will we not have more sort of domino effects in terms of correlated sellings into falling markets? Will it then be contained to the US or not? Well, I don't know. I think, as I said, also a significant part of private credit supply in Europe is being provided by US entities. So there's a natural contagion channel there as well. So, I mean, it's difficult to really pinpoint how the risks will manifest itself, but at the same time, it has a lot of analogies with fast-growing areas in financial intermediation that we've seen in the past. Then, that was and the new elements. Well, I mean, information is flowing much faster, that's true, but we've worried already for a long time about fast trading, correlated tradings, and AI, I think, is another step up in that development. And yes, it will probably mean that the response will have to be faster. And unfortunately, there is only one party that can react very fastly if there is a crisis response being called for, and that is the central bank.
Very, very briefly, I mean, I think Klaas covered it, but on the new mechanism, yes. So speed, we've seen that with SVB, for instance. The bank runs can happen in a matter of hours and not in a matter of weeks. Clearly, that makes a difference, and banks need to be prepared, and having access to the discount window may be a good idea. The AI is also important in terms, if you think about how the models are trained. The pattern of covariances that you're seeing in the historical record is what the AI will actually reproduce. It will not have data to necessarily think about a different pattern. And so the question is, if those patterns break down, can it lead to trades that amplify a downturn? And can you pull the circuit breaker fast enough? Right? That's kind of that's how I would put the question. On Jose Luis' question on the, I think this is conceptually, I think you're exactly right, that somehow if you know that there is a backstop, then in a sense you know that somehow the banks are holding that debt are also indirectly protected. That should be factored in. You'd still want to think about the incentives that it provides and whether you want to deal with the moral hazard and all of this, but it's certainly part of the environment. Yeah.
So thank you very much. I'm afraid we won't have time for another round, so I think we have to wrap up after a really fascinating discussion, and I would really like to thank my two panelists. I cannot summarize everything that was said, but let me just stress a few points. So I think one point that came out of the discussion is that some of the regulation that may be needed requires international collaboration. And as Klaas pointed out, that is becoming increasingly difficult. And the question is, what does that mean for global financial stability? A second point that I think is very important are the fiscal issues, and Pierre-Olivier rightly stressed the point that this is not just a problem in itself, but that it also has an impact on financial stability, because in the end we are relying on governments to act in case there is a crisis, and that's a very important point. And the third point I would like to stress is related to innovation, so everything we discussed, crypto, stable coins, AI, distributed ledger, and so on. And of course, there's always a question, how much do we want to embrace that innovation and how much do we need to regulate it? And that's, of course, something that also in Europe we have to rethink. So thank you very much. I think we do not have to remove the question mark from the title of the conference. So we are aware of many risks that we face, but we also have many ideas what needs to be done. And so thank you very much to my two panelists and also to a great audience.